million to $1.8 billion. John has also served for many years as one of 3 managing partners of Wellington Management Company. His investment acumen complements his business acumen. John is not only the profession's professional investor, he is an exemplar as a servant fiduciary, always centered on his chosen responsibilities as investment manager for the families and individuals who have entrusted their savings to the mutual funds he manages. The best investment decision I ever made was to buy, 25 years ago on maximum margin, the so-called capital shares of the Gemini Duo Fund. A Duo Fund, no longer allowed, was a special class of mutual funds in which half the money invested at the initial public offering got all the dividends, and half the money invested got all the appreciation or capital gains. In the then prevailing bear market, stocks were far below their past valuations, and investor sentiment was and had long been consistently negative. This scenario created great opportunities for a contrarian investor, particularly one specializing in value stocks, which had been particularly hard hit. Gemini's capital shares had, of course, borne the brunt of the bear market and were selling at a serious discount. If the market recovered, the capital shares would rise with disproportionate rapidity, roughly twice as fast, because of the Duo Fund structure. If value stocks returned to normal relative valuations, a reasonable expectation among those who recognize the powerful tendency of stock market valuations to regress to the mean, a portfolio managed by John Neff would enjoy at least a quite favorable environment. And that superior performance could soon eliminate the then current market discount. John was recognized as a superior investment manager who could be expected to outperform the market, as he had done again and again. So I had 5 complementary forces ready to work hard together for me: John Neff, value stocks, mean regression, a current market discount, and nearly 2-for-1 leverage on the upside. Still, the key factor in this investment decision was the sure knowledge that John Neff would have structured the portfolio and selected its holdings with extra care and attention to risk. Emboldened by the conviction that America was being sold short by investors, I made a worst-case estimate of the risk of a further drop in the market. The most I could imagine was another 20%. If this figure was correct, the rational course of action would be to borrow the maximum 30% of margin through my stockbroker and plunge deeply into purchasing the capital shares of Gemini. The stock market went up. The capital shares went from a discount to a premium. Value stocks became the market's darlings. The leverage of a Duo Fund worked its wonders, and John Neff continued to outperform his peer group. All 5 forces were locked in together, and a 6th, margin leverage, ensured my son's education expenses. Luckily for me, in many ways, my relationship with John Neff goes way back. When I first met him in Philadelphia 35 years ago, I knew 2 things almost instantly. First, he was very smart, well-informed, and serious about knowing more. Second, I liked him, and I liked the cut of his jib. A few months later, John Corcoran, investment strategist for Donaldson, Lufkin & Jenrette, DLJ, was giving an erudite discourse on the investment opportunities available in different sectors of the market. While all the other professional fund managers in his rapt audience were cheerfully focused on how much some particular stocks could go up, the meeting was brought to an awkward halt by Neff's blunt question to Corcoran. "John, what about risk?" That cinched it for me. Here was a truly independent thinker. I've been listening to John Neff on every possible occasion ever since, as a shareowner in the mutual funds he manages, at professional meetings sponsored by the Association for Investment Management and Research, AIMR, at portfolio manager seminars sponsored by DLJ, and, quite happily in recent years, in his role as a director of Greenwich Associates. A cheerful confession. From the very beginning, I strongly encouraged John to write this book, partly so I could read John Neff on investing, partly so my sons and friends could, and partly so any serious student of the profession could benefit from the best thinking by this great investor. Charles D. Ellis, Greenwich, Connecticut, June 1999. Preface. In the spring of 1998, I taught a graduate seminar on investing at the Wharton School in Philadelphia. A very lively group of students sparked extensive reflection on my part. Aspects of my life fell together in answer to dozens of questions about the nature of the investment process and why I chose the path I followed. This book continues my conversation with these students. A book is a one-sided conversation, to be sure. But like a good conversation, it can express a point of view in an informal manner, unencumbered by charts and graphs that often clog books on this subject. If we shared a compartment on a long train ride, what you read in these pages is what I'd tell you about investing. I have highlighted the ideas that seem most enduring to me after 3 decades at Windsor, rather than supply a laundry list of topics related to investing. You can find other books for that. Teaching invited many questions about my own learning curve. I'm not sure where it began exactly. I joined the U.S. Navy and studied aviation electronics before I dreamed of trading stocks, much less managing the largest equity mutual fund in the United States, the status Windsor held until the doors were closed to new shareholders in 1985. Perhaps my career started before I learned to count. I was always a stubborn little fellow, which my mother expressed very succinctly. "John Brown," she declared, "you would argue with a signpost." She was not only right, she was prescient. My whole career I have argued with the stock market. Happily, as the Windsor Fund's record shows, I won more arguments with the market than I lost. Wherever learning curves begin in this mercurial business, they never seem to end. That's the marvel and also the heartbreak of the stock market. You can line up more experts than you can shake a stick at, but none can predict with certainty what investors really want to know. How will the market do tomorrow, or next week, or next year? An inexhaustible flow of new information produces outlooks no one has seen before. An early Greek philosopher, Heraclitus, observed that a person cannot step twice in the same river because the river changes constantly. Nor, in the same sense, can an investor step twice in the same market, because the market changes constantly. Hang around long enough, though, and you will begin to recognize the market's personality. It is irrational and unsentimental. It is cantankerous and hostile. At times, it is forgiving and congenial. The market has good days and bad days, good years and bad years. You can't predict them, and they can reverse course with stunning speed. But you can learn to cope with them and improve your odds. In the bargain, you can make good money. Contrarian that I am, the format for this book is intentionally unorthodox as books on investing go these days. It is not about Hail Mary passes. It's about grinding out grains quarter after quarter, year after year. My kind of investing rests on 3 elements: character, goals, and experience. Therein lies the 3-part structure. Part 1, My Road to Windsor, is about my character. Part 2, Enduring Principles, portrays goals and mechanics. And Part 3, A Market Journal, records how events played out during the last quarter-century of my Windsor career. All were written with an eye to smarter investing, whether you trade one stock a year or a stock a day. I don't recommend the latter. It seems pertinent at this juncture to add a note about the performance of value investing in the late 90s. Many so-called value funds have suffered a rough road. As a contrarian, I say that's to be expected. When better to write a book about out-of-favor investing than when it's out of favor? Being out of fashion ultimately enhances opportunities on the other side. On my watch, Windsor weathered trying times more than once, but still managed to spring back with championship results. Individual investors enjoy a key advantage over professionals in one critical respect. You can pick and choose stocks and bide your time unflustered by the fierce and often corrosive quarterly performance sweepstakes, especially in hostile market climates. Value investing, with a focus on low price-earnings ratios as I practice it, demands sober reflection. Scarce to begin with, sober reflection gets even scarcer as bull markets progress. Eventually, good stocks of good companies with solid earnings and low price-earnings ratios receive the attention they deserve. With patience, luck, and sound judgment, meanwhile, you keep moving forward. That's the nature of the investment game. Now and then a windfall, but mostly a 4-yard gain and a cloud of dust. My investment style can give investors a lucrative edge over the long haul. But if you can't roll with the hits, or you're in too big a hurry, you might as well keep your money in a mattress. John Neff, Valley Forge, Pennsylvania, June 1999. Prologue. City Saga. Most investors feared for Citibank in May 1991. Amid real estate problems galore and on the heels of cleaning up disastrous loans to